Question: from the following balance sheet of Star Limited as at 31st March 2020, prepare cash flow statement. Equities and liabilities, shareholders funds, share capital 3,50,000, 3 lakhs. Reserves and surplus 70,000, 50,000. Non-current liabilities, long-term borrowings 12% debentures 80,000, 1 lakh. Current liabilities, short-term borrowings, bank loan 15,000, 25,000. Trade payables 1,65,000, 60,000. Assets, non-current assets, fixed assets 4,10,000, 3 lakh. Non-current investments 40,000, 50,000. Current assets, inventories 52,000, 30,000. Trade receivables 60,000, 40,000. Cash and cash equivalents 1,18,000, 1,15,000. Balance sheet total 6,80,000, 5,35,000. Notes to accounts: reserves and surplus, capital reserve previous year 0, current year 2,000. General reserve previous year 20,000, current year 33,000. Balance in statement of profit and loss previous year 30,000, current year 35,000. Next, fixed assets, tangible machinery at cost previous year 3,50,000, current year 4,70,000, less accumulated depreciation 60,000, 50,000. Additional information: during the year, machinery costing rupees 20,000, accumulated depreciation rupees 15,000 was sold for rupees 12,000. During the year, non-current investments were sold at a profit of rupees 20%, which is transferred to capital reserve. Debentures were redeemed at par on 1st April 2019. Tax of rupees 15,000 was paid during the year. Interim dividend paid during the year amounted to rupees 25,000. Board has proposed final dividend for the previous year, that is for the year ended 31st March 2019 at 10% per annum. The shareholders did not declare or approve the proposed dividend. Cash flow statement. First activity, operating activity. Operating activity starts with net profit before tax and extraordinary items. Working note number 1, calculation of net profit before tax and extraordinary items. First, difference between statement of profit and loss. Statement of profit and loss previous year's amount 30,000, current year 35,000. Difference 5,000 is the profit made during the year. Next, transfer to reserve. Previous year's general reserve 20,000, current year 33,000. So, amount transferred to general reserve is rupees 13,000. In this case, gain on sale of non-current investments has not been transferred to statement of profit and loss. It is directly transferred to capital reserve. It is not transferred, it has not been transferred to statement of profit and loss. So, it will not be adjusted while calculating operating profit before working capital changes. Next, provision for tax. Tax paid is rupees 15,000, which is given in the adjustment. Tax of rupees 15,000 was paid during the year. Next, interim dividend paid. Interim dividend is rupees 25,000. Proposed dividend of previous year will not be taken into consideration while calculating net profit before tax and extraordinary items, because it is not approved by the shareholders. So, net profit before tax and extraordinary items rupees 58,000. Net profit before tax and extraordinary items 58,000. Next, adjustment for non-cash non-operating items. First, depreciation. Amount of depreciation is not given, but accumulated depreciations of previous year and current year is given, and accumulated depreciation of assets sold is also given. So, second working note is calculation of depreciation, preparation of accumulated depreciation account. Credit side opening balance, that is balance brought down 50,000. Debit side balance carried down 60,000. Then debit side to machinery account, that is the accumulated depreciation of asset sold. Accumulated depreciation account is debited with closing balance and depreciation of accumulated depreciation of assets sold, and credited with opening balance of depreciation, accumulated depreciation. Balancing figure rupees 25,000 is the depreciation charged to profit and loss account. Depreciation is rupees 25,000. Depreciation 25,000. Then interest on debentures. Interest on debentures, amount of debentures. Previous year 1 lakh, current year 80,000. Debentures were redeemed at par on 1st April 2019. Debentures amounted to rupees 20,000 were redeemed on 1st April 2019. So, interest on debentures rupees 9,600, that is 80,000 into 12 by 100. Then gain on sale of machinery. Calculation of gain on sale of machinery. Working note number 3. Cost of machinery rupees 20,000. Adjustment number 1. Cost of machinery rupees 20,000. Then accumulated depreciation of machinery 15,000. Accumulated depreciation or depreciation up to the date of sales 15,000. Cost 20,000. Depreciation up to the date of sales 15,000. Value of machinery as on the date of sales rupees 5,000. Amount received through the sale of machinery rupees 12,000. Cost of machinery or value of machinery as on the date of sales 5,000. Sales price 12,000. Profit on sale 12,000 minus 5,000, 7,000. Profit on sale or gain on sale of machinery is deducted from net profit before tax and extraordinary items rupees 7,000. Operating profit before working capital changes 85,600. Next, adjustment for working capital. Increase in trade payable 1,05,000, which is added to operating profit before working capital changes. Then increase in inventory and increase in trade receivables deducted from operating profit before working capital changes. Amount after adjustment is 1,48,600. Next, in deduction of income tax paid. Income tax paid is rupees 15,000. Net amount after adjustment 1,33,600 is the cash from operating activity. Next activity, investing activity. Investing activity, working note number 4, preparation of machinery account. Opening balance 3,50,000. Closing balance 4,70,000. Accumulated depreciation 15,000. Credit side, accumulated depreciation 15,000, that is the depreciation of assets sold. Then bank on credit side is the sales price rupees 12,000. Profit on sale of machinery rupees 7,000 is debited. Balancing figure rupees 1,40,000. 1,40,000 is the purchase of machinery. Machinery account is debited with opening balance and profit on sale of machinery. Credited with accumulated depreciation, sale of machinery and closing balance. Balancing figure rupees 1,40,000 is the purchase of machinery. Next, preparation of non-current investment. Opening balance of non-current investment 50,000. Closing balance 40,000. Profit on sale, which is transferred to capital reserve rupees 2,000. Then sales price rupees 12,000 on credit side. Investing activity, purchase of machineries and outflow of cash, rupees 1,40,000. Sale of machinery, inflow of cash 12,000. Sale of investment 12,000. Cash used in investing activity 1,16,000. Next, financing activity, issue shares 50,000. Interim dividend paid 25,000 outflow. Redemption of debentures 20,000 outflow. Interest on debentures, payment of interest 9,600 outflow of cash. Bank loan repaid 10,000 outflow of cash. Cash used in financing activity 14,600. Cash used in financing activity 14,600. Next, calculation of net increase or decrease in cash, A plus B plus C, that is operating activity plus investing activity plus financing activity. Amount of operating activity 1,33,600, that is an inflow. Then outflows in investing and financing activity 1,16,000 and 1,16,000 and 14,600. Amount after adjustment is rupees 3,000, net increase in cash. Next, cash and cash equivalents in the beginning 1,15,000. Amount after adjustment 1,18,000 is the cash and cash equivalents at the end.